You need to hear this if you're planning for retirement. When you think about retirement, the first thing that often comes to mind is financial security. For most people, this means putting money aside in a retirement account, like a 401k. A 401k is one of the easiest ways to begin investing and growing your wealth over time, especially if your employer offers a matching contribution. However, as popular as 401ks are, simply contributing to one doesn't guarantee you'll retire comfortably. In fact, many people don't realize that they're making mistakes with their 401k that could severely impact their financial future. To put it into perspective, the average 401k balance is just a little over $100,000, and that's a far cry from what most people need. According to estimates from AARP, an individual needs around $1.2 million saved to generate an annual income of $40,000 over a 30-year retirement. So, what's going wrong? It's often that people don't know how to properly manage their 401k accounts. The good news is that small adjustments today can make a huge difference later. In this video, we'll break down 7 common mistakes people make with their 401k and how you can avoid them. These aren't just financial tips, they're strategies to help you retire with confidence. But before we dive in, let me introduce myself. I'm Chris, and on this channel, we discuss personal finance, investing, and making smarter money decisions to ensure you achieve financial freedom. If that sounds like something you're interested in, make sure to subscribe and hit the like button. Mistake number 1. Not taking full advantage of employer matching. If your employer offers a 401k match, this is one of the simplest ways to boost your retirement savings. Employer matching is essentially free money. For every dollar you contribute up to a certain percentage, your employer will match it. For instance, let's say your employer offers a 100% match up to 6% of your salary. If you're earning $50,000 per year, contributing 6% would equal $3,000. Your employer would match that $3,000, effectively doubling your contribution to $6,000. Not bad, right? However, many people aren't contributing enough to maximize this benefit. This is like leaving money on the table. It's shocking how many people contribute less than what their employer is willing to match. The power of vesting. One thing to be aware of is vesting, which means that while your employer may contribute to your 401k, you don't fully own that money right away. Many companies have a vesting schedule where you gradually earn full ownership of their contributions over a period of time, usually 3 to 5 years. If you leave the company before you're fully vested, you could lose some or all of the money your employer contributed. Pro tip: check your vesting schedule before switching jobs. Sometimes staying an extra year could mean walking away with thousands of dollars in employer contributions. Mistake number 2. Cashing out. When you change jobs. One of the worst financial decisions you can make is cashing out your 401k when you change jobs. Not only do you face hefty penalties for early withdrawal, but you'll also owe taxes on the money you withdraw. On top of that, by taking money out of your account, you're sacrificing years of growth and compound interest. For example, let's say you have $20,000 saved in your 401k, but you decide to cash out when you change jobs. You could lose around 30% or more to taxes and penalties. Now you're down to $14,000. That $6,000 lost isn't just money out of your pocket now, it's money that could have been growing exponentially over the years. What you should do instead. The smarter option is to roll over your 401k into a new account. If your new employer offers a 401k plan, you can roll your old 401k into it. Alternatively, you can roll it into an IRA, which might offer more investment options and flexibility. A direct rollover allows you to transfer the funds from one account to another without touching the money yourself, avoiding unnecessary taxes and penalties. Mistake number 3. Not increasing contributions as your income grows. When you first start contributing to a 401k, you might pick a conservative percentage of your income to put away, such as 3% or 5%. This is a great start, but it's crucial to increase your contributions as your income grows. Here's why. If you're earning $50,000 and contribute 5%, that's $2,500 a year. But let's say you get a raise and your salary goes up to $60,000. If you're still contributing only 5%, that's $3,000 a year, an increase of only $500. However, if you bumped up your contribution rate to 8% or 10%, your retirement savings would grow significantly faster. A simple rule to follow. Each time you get a raise, aim to increase your 401k contribution by 1 to 2%. You won't feel the difference in your take-home pay, but those extra contributions will compound over time and make a huge difference by the time you retire. Think about this. A 1% increase today could mean thousands more when you're ready to retire. It's a small sacrifice for long-term security. Mistake number 4. Ignoring your investment performance. When was the last time you checked how your 401k investments were performing? Many people set their investment options when they first open the account and then never look at them again. This is a mistake because markets change, and what worked for you 5 years ago may no longer be the best option today. The importance of asset allocation. Asset allocation refers to how you distribute your investments among different types of assets, like stocks, bonds, and cash. As you approach retirement, it's essential to adjust your allocation to reflect your risk tolerance and retirement goals. If you're still a few decades away from retirement, you can afford to take more risks and invest in growth-oriented funds. But as you get closer to retirement, you'll want to shift toward more conservative investments to protect your savings. Pro tip: set a reminder to review your 401k investments at least once a year. Many employers offer target date funds, which automatically adjust your asset allocation based on your expected retirement date. These funds can be a great option if you prefer a hands-off approach. Mistake number 5. Overloading on company stock. Many companies offer their employees the chance to buy company stock, sometimes at a discount. While it might seem like a great idea to load up on company stock, it's important not to put too much of your retirement savings into one company, even your own. Here's why. If your company hits hard times or, worse, goes bankrupt, you could lose both your job and a significant portion of your retirement savings. Remember Enron? Many employees had the bulk of their 401k tied up in company stock, and when Enron collapsed, so did their retirement plans. Diversification is key. To protect your retirement savings, make sure you diversify your investments. Experts recommend limiting individual stock to no more than 10 to 20% of your total portfolio. The rest should be spread across a range of investments, like index funds, that give you exposure to a variety of companies and industries. Mistake number 6. Ignoring the fees in your 401k. Fees might seem small, but over time, they can significantly reduce the amount of money you'll have in retirement. Most people don't pay much attention to the fees associated with their 401k plan, but even a 1 to 2% annual fee can eat away at your savings. Here's an example. If you have $100,000 in your 401k and it grows by 7% per year, you'll have around $574,000 after 30 years. But if you're paying a 1.5% annual fee, your account will only grow by 5.5%, leaving you with about $467,000. That's a difference of more than $100,000 just because of fees. How to minimize fees. Look into the expense ratios of the funds in your 401k and consider switching to lower cost options, like index funds or ETFs. These types of funds typically have much lower fees than actively managed funds, which means more of your money stays invested and working for you. Mistake number 7. Taking early withdrawals for big purchases. Sometimes life throws unexpected expenses your way. A medical emergency, a home renovation, or even the temptation to buy a new car. While it might seem tempting to tap into your 401k to cover these costs, this is one of the biggest mistakes you can make. Withdrawing from your 401k early comes with a 10% penalty if you're under 59.5, plus you'll owe income taxes on the amount you withdraw. But perhaps even worse, you'll lose the potential growth of that money over time. What to do instead? Before you even think about tapping into your 401k, make sure you have an emergency fund in place. This should cover at least 3 to 6 months of living expenses. An emergency fund will help you handle unexpected costs without needing to dip into your retirement savings. Additionally, consider other financing options for big purchases, like taking out a loan with lower interest rates, rather than cashing out your 401k. Remember, the money in your 401k is meant to grow over time, and each dollar you take out today can have a massive impact on your future retirement balance, thanks to compound interest. Why compound interest matters. Compound interest is one of the most powerful tools you have when it comes to growing your wealth. When you leave your money in a 401k, it earns interest. Over time, the interest you earn also begins to earn interest, and this snowball effect allows your money to grow much faster than it would if you were simply adding money without any growth. For example, if you invest $10,000 today and earn an average return of 7% annually, in 30 years, your money will grow to nearly $76,000. But if you take that $10,000 out early, you lose not only the initial amount, but also all the potential growth that money could have generated over the decades. Bonus tip: take advantage of Roth 401k options. While traditional 401ks offer tax-deferred growth, meaning you don't pay taxes on your contributions until you withdraw the money in retirement, many employers now offer a Roth 401k option. With a Roth 401k, you contribute after-tax dollars, but your withdrawals in retirement are completely tax-free. For some people, a Roth 401k can be a better option, especially if you expect to be in a higher tax bracket during retirement. By paying taxes up front while your income is lower, you can avoid paying higher taxes on your withdrawals when you retire. Why you should consider tax diversification. Having both traditional and Roth retirement accounts gives you more flexibility in retirement. For example, if you expect to have significant taxable income from other sources during retirement, you can withdraw from your Roth 401k tax-free, reducing your overall tax burden. On the other hand, if you're in a lower tax bracket in retirement, you might prefer to withdraw from your traditional 401k and pay taxes at a lower rate. Pro tip: if your employer offers a Roth 401k, it's worth considering splitting your contributions between the traditional and Roth options. This way, you'll have more control over how and when you pay taxes in retirement. How to build a retirement strategy beyond your 401k. While a 401k is an excellent starting point for retirement savings, it shouldn't be your only strategy. To ensure you're truly prepared for retirement, consider diversifying your investments by opening additional retirement accounts, such as an IRA or taxable brokerage account. Open an IRA. Whether it's a traditional or Roth IRA, these accounts offer more investment options than a 401k, and they often come with lower fees. If you've maxed out your 401k contributions for the year, contributing to an IRA can give you another tax-advantaged way to grow your wealth. Consider a health savings account, HSA. If your employer offers a high-deductible health plan, you may be eligible for an HSA. These accounts come with a triple tax advantage. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. HSAs are a great way to save for healthcare costs in retirement. Invest in a brokerage account. While brokerage accounts don't offer the same tax advantages as retirement accounts, they provide more flexibility. There are no contribution limits, and you can access your money at any time without penalties. This can be a great option for long-term wealth building, especially if you're already maxing out your 401k and IRA contributions. Final thoughts: small changes. Today, big results. Tomorrow. Retirement planning doesn't have to be complicated, but it does require attention and some smart decision-making. The 7 mistakes we've discussed here, from not taking advantage of employer matching to ignoring investment performance and taking early withdrawals, are all common, but they're also avoidable. By making small changes to how you manage your 401k today, you can set yourself up for a much more comfortable and secure retirement tomorrow. The key is to be proactive. Review your 401k regularly, adjust your contributions over time, and make sure you're taking advantage of all the tools available to you. Remember, the sooner you start optimizing your 401k, the better. Time is your greatest asset when it comes to growing your retirement savings, so don't wait to make these changes. If you found this video helpful, make sure to hit the like button and subscribe for more tips on personal finance and investing. And if you have any questions about your 401k or retirement planning in general, drop them in the comments below. I'd love to help you out.